Hey guys, welcome back. Today we will dive into the third quarter results of Dropbox. We will go through their numbers, we will see what were they doing in third quarter, how did they do, what is management guiding, what are some really interesting comments from the management in the call after the third quarter earnings. Then we will see some of the critics which are happening on the internet and thinking alpha which I've seen recently, and they are trying to build some kind of bearish case against around this company. I will explain to you how do I look at that particular issue and a lot of different things. But before that, as always, I will just show you fast performance of my portfolio. As you can see, it went up again from 22% year-to-date return to above 30% return. I mean, everybody was preparing for huge fluctuations around the US elections. Even fund managers, professional, which I am tracking, they were buying a lot of put options. They were hedging their portfolio, they were preparing for doomsday scenario. And what actually happened is we've seen huge growth in stock prices and in S&P 500 before and after the elections. So once again, we saw that you can never guess what is going to happen on the markets. So it is best to buy good company with good balance sheet, good products, and just stay long. That is the best thing you can actually do. So let's dive into Dropbox results. First of all, you can see here their revenue grew 14% compared to the same quarter on the last year. You can see this beautiful uptrend from 2017 to 2019. This year they plan to reach almost $2 billion of revenue, and that's really nice. But what really amazed me and what I'm really looking for and what I'm really tracking is this part of this screenshot, and that is operating margin. They almost doubled operating margins in one single year. And that is what actually I emphasized in one of my past videos. When you combine growth in number of users which are paying for their services with average revenue per user, you will get perfect cocktail for really fast margin expansion. And that is what actually we are seeing right here and what we will continue seeing in the future reports. That is what excites me most. You can see something similar here. Revenue went again for 14% up to almost $500 million in one single quarter. You can see that they finally became profitable, and they will be profitable even more in the future. They generated net income of almost 33 million compared to the loss of 17 million last year. This is what happens when you double your profit margins in 1 year. And even better thing to see is this. Their free cash flow is $187 million in one single quarter. So net cash provided by operating activities is over 200 million. It's really nice to see 200 million of net cash. And then again, you can see free cash flow margins. They went from almost 24% in 2019 to over 38% in 2020. Again, they are still increasing number of users which are paying for their services, and average revenue per user is also increasing. Again, we are still seeing that perfect cocktail mix for further margin expansion. You can see exactly that on comments from the management. They added nearly 300,000 paying users, and they combined that with growing average revenue per user. That's what I was speaking about in my previous video, and that is what I'm emphasizing right now. That is really bullish trend, and I loved seeing those numbers. But what happened recently is actually more and more people are saying that Dropbox is not investable right now, and the thing that they are mentioning is number of shares outstanding. So Dropbox was issuing a lot of shares, probably because they were not profitable, and they tried to mitigate a lot of their expenses by issuing new shares, and they were covering some of their costs with those shares. Most of those shares, of course, were bonuses for their employees, because on the one hand they are based in California. If, for example, they would give bonuses to their employees in cash, California would take most of those bonuses via taxes, and when you give your employees shares of your company, almost 100% of that revenue they generate from selling those stocks end up on their bank account. So that is actually benefiting their employees, and that is benefiting free cash flow of the company because they don't have to spend cash, they just issue stocks. And I can understand why management did that in the last few years, since they were generating losses and they wanted to save some money and to reward their employees. And consequently, you can see on this beautiful chart, or not so beautiful, trend of number of shares outstanding of Dropbox. You can see from 2017 to 2020, quite significant trend of issuance of new shares. And of course, investors dislike this. Why? Because they are actually diluting our ownership of the company. And that is really good argument to emphasize, and everybody should know this. But what happened in last 6 or 7 months, you can see that trend actually reversed. Not that only it stopped growing, number of shares outstanding, but it started slightly decreasing. Because I think management recognized that this is becoming bigger and bigger issue and that their stock price is not moving anywhere. For last several years it's been at around $20 level, and they actually addressed this issue. And this is another sign which really made me happy last night and made me even more bullish. As you know, I have 400 shares of Dropbox, and it is actually my biggest position right now. 400 shares for most of my viewers perhaps is nothing, but when you have a portfolio of around $40,000 to $50,000, it's really important position to me. What made me happy is actually this. So they plan to drive annual improvements in operating margins. That's what I spoke already about. You saw how their profit margins expanded. They plan to double free cash flow to $1 billion in 2024, which actually represent average growth of 20% in next several years. And then look at this. Thoughtfully allocating capital to organic initiatives, M&A opportunities, as exemplified by HelloSign, and returning capital to shareholders through share repurchases. That's what I wanted to hear. And look at this part. As we work to achieve our stated long-term targets, we plan to leverage our ability to generate cash by allocating a significant portion of our annual free cash flow to share repurchases on an ongoing basis, which means that they started doing this year and they plan to do it in the future, with the intention of maintaining a spend level that will at least offset dilution. So what are they trying to say here? Worst case scenario is that number of shares outstanding of Dropbox will stop going higher. They will maintain current number of shares outstanding, which is really good thing to see, since you've seen the chart, they were trending upwards. But then they say this, and potentially reduce share count. We also expect to invest in future M&A opportunities, utilizing the cash on our balance sheet, cash we generate, and do not spend on buybacks and our balance sheet debt capacity. What are they saying is actually, look guys, we are generating really robust cash flow. Our operating margins are expanding rapidly. We will generate more and more cash in the future. We have more than $1 billion on our balance sheet and zero debt, and we will start investing that money. They will buy back their shares, they will do some acquisitions, they will invest heavily to keep generating double-digit revenue growth in the future. So the biggest argument that the bears had about Dropbox and their share dilution actually completely disappeared in this investor call. They really emphasized a lot this share buyback. They mentioned it several times during the call. So actually we don't really have to worry about our investment in Dropbox diluting additionally. Not only that, but imagine they will probably increase their share buybacks because Dropbox is really undervalued at these prices. And imagine them having $1 billion of free cash flow annually, and Dropbox is worth right now about, $7, $8, $9 billion. So they will be able to buy more than 10% of their company every single year if the price stays the same, which I doubt it will. I think we will see stock price growth in the near future. And then again, look at this. For the full year 2020, we are raising our revenue guidance range, which was previously up to $1.9 billion to $1.91 billion. So they slightly raised their guidance. And again, they are really conservative when they are guiding. They always beat their guidances. So we will probably see even higher numbers at the end of this year. What also happened on this call is that they were speaking a lot of new things that they're ramping in their company. They have several new features. Mostly they spoke about HelloSign, which is actually number 2 e-sign service at the markets right now. And remember, they just pushed it live. So it's really being adopted at fast pace on the markets and their users. They're also moving to virtual first company, which means that most of their employees will work from home. And this will have a financial impact as we take steps to de-cost our real estate portfolio. As you know, Dropbox is from San Francisco, and you've probably heard that San Francisco has one of the most expensive real estates in the world. So reducing costs and needing less real estate space and less commercial estate will help to boost profit margins even additionally. Another interesting thing is this: we are always on the lookout for great opportunities there. Remember, they have great balance sheet, they have zero debt, they have more than $1 billion of cash, and on top of that they are generating more than $500 million of free cash flow right now, every single year. And that will double in next 3 years. And then again they said there that their strong balance sheet, free cash flow, that they got the firepower to pursue these opportunities with a big user base and platform to help drive distribution. So certainly on look out for new opportunities and will be disciplined with this investment. So they will not rush into any investments just so they can brag that they are doing something and that they can hype the markets and increase their stock price. I like this long-term view, and I'm really happy that I made this company number one position in my portfolio. Everything they said really seems to be cautiously bullish. They're not trying to sell us some story, some great future. Wherever I looked at numbers, profit margins, free cash flow, revenue, it's steady. Average revenue per user is growing. They are innovating. They are building up new features. And they really spoke several times about share buybacks. So we don't have to worry anymore about our shares being diluted. Actually, contrary to that, we can expect them to decrease number of shares outstanding with increasing share buybacks.